Everyone says the US deficit is unsustainable. Politicians call it reckless. Markets panic about debt ceilings and bond auctions. But here's the contrarian truth. That same deficit is also the reason the US economy is still growing. And the signal that proves it isn't GDP or inflation. It's PSFB, the public sector financial balance. The hidden number economists track that shows how government deficits don't just add to debt, they drive the cycle of growth. This is Global Notes by JP. Subscribe if you want the second-level signals behind the economy. PSFB is the government's net fiscal position as a share of GDP. Negative means deficit. Washington is injecting demand. Positive means surplus. It's pulling demand out. But here's the deeper truth. The economy is three balances that always add up: private, public, and external. If households save more, then either government must spend more or the country must export more. That's the accounting identity, and it's the hidden pulse of the economy. During recessions, households save more and firms cut back. Their balance swings positive. For the system to hold, government usually goes negative, not because it's forced, but because without public spending, the economy would collapse. In 2009, the private surplus jumped near 10% of GDP. Washington ran deficits of 12% to match. That didn't erase the crash, but it stopped depression. In 2020, the private surplus soared to 15%. Government matched it with deficits of 15%. That's why incomes and markets bounced back so fast. What if everyone saves? Households, firms, and government too. That's austerity, and it deepens recessions. In the late 1990s, the US ran a fiscal surplus of 2% of GDP just as households were pulling back. By 2001, the economy tipped into recession. In the Eurozone debt crisis, governments forced into surpluses of 2 to 3% turned downturns into stagnation. No one spent, and the result was years of lost growth. Sometimes the opposite happens. Households and firms spend more than they earn, going negative. The economy looks strong, but it's built on borrowing. In 1999 and 2000, the private balance fell to -4% of GDP as the tech bubble fueled investment and credit. Government was in surplus. Growth looked unstoppable until the bubble burst. In 2005 to 2007, the private balance fell again to -5%, driven by mortgage borrowing and housing wealth extraction. Government was near balance. The system looked fine until it collapsed. Private deficits often signal bubbles. When credit stops, the private balance flips positive and government is forced into deficit to keep the system afloat. And then there are moments when both government and households spend at the same time. That's when the economy runs hot. In the late 1960s, Vietnam War spending plus strong consumer demand overheated the economy. Inflation spiked, the Fed slammed the brakes, and recession followed. In 2021, trillions in stimulus checks collided with pent-up consumer demand. Growth roared, but inflation surged to 9%. When both sides run deficits, the risk isn't recession. It's overheating, inflation, and bond market stress. Today, the US is running a deficit of around 6% of GDP, one of the largest peacetime levels in history. Households are cautious but not collapsing. Firms are under pressure from high rates. That means Washington is leading growth. It explains why the economy looks resilient even under 5% interest rates. And it explains why bond yields remain elevated, because investors see fiscal demand colliding with tight monetary policy. So can PSFB predict recessions with precision? No, there's no magic number. But it tells you the direction of risk. Big private surpluses with government deficits mean recessions are cushioned. Both surpluses mean austerity and stagnation. Private deficits mean bubbles and crisis risk. And both deficits mean overheating and inflation. This is the balance sheet mirror economists at the Fed and IMF quietly track. Markets mostly ignore it, and that's what makes it powerful. Almost everyone talks about the deficit as a danger. Few see it as the hidden driver of growth. PSFB forces us to look differently, not at debt charts, but at the engine of demand that keeps the economy running. Ignore it, and you'll miss the real pulse of the economy. This is Global Notes by JP. Subscribe if you want to see past the headlines and catch the real signals behind every shift in the data.